And I believe this is one of the biggest reasons why people have trouble beating the S&P 500 and have trouble targeting 15 to 20% plus returns. Welcome to episode 22 of the Visionary Investor Podcast. Today we're going to talk about asset selection. And now why this is so important is because the assets you choose in your stock portfolio, along with the weights, are going to impact your performance, your risk you experience, and the price movements throughout the life of your portfolio. This is going to be a multiple part series, and in this episode, I'm breaking down 5 different stocks in the consumer staples sector. These are more defensive companies. This is more of a defensive sector. At the end of the day, a lot of these are essentials regardless of what's going on in the economy, especially if they're selling a lot of food and essential items like toilet paper, paper towels, Band-Aids, and so forth that are more necessity than some of your other sectors like consumer discretionary. Right off the bat, what I see here is that Costco and BJ's are the only 2 companies that had above 15% annualized returns over the past 5 years. In the past, what I've done for asset selection was look at research reports, follow the news, look at analyst recommendations, and I've found that you can do this better yourself. Of course, it can help you to use the knowledge of others, but when you're not actually forming the opinion from the ground up of what's going on with those investments, it makes it harder for you to be involved and actually part of that decision-making process of picking those assets for your stock portfolio. So what do I mean by this? I used to use Value Line, Zacks Investment Research, and a bunch of other methods, but primarily Value Line when I was investing in the stock market early on. Eventually, I started shifting this method to doing my own research from the ground up. So doing my own fundamental analysis, quantitative and qualitative, in order to find those visionary companies. And by doing this, what I realized is relying on myself versus relying on information from others has made it so much easier for me to see the full picture of what's going on in the stock market, and this is what I want for you too. So even if you have an advisor, I still strongly suggest do your research, because then you can have such a great conversation with your advisor to determine if the asset is actually one that aligns with your goals and truly is something that you can see outperforming in the long run. Because a lot of times people invest in something because they think it's popular, or because their advisor or their friend or family told them it's a great stock. But when you do your own research, you're going to notice something different that people oftentimes miss. And I believe this is one of the biggest reasons why people have trouble beating the S&P 500 and have trouble targeting 15 to 20% plus returns. First thing I like to do is go to Fidelity Investments. I've used Fidelity's stock screener to break down the 11 sectors of the stock market. And I have it in front of me. There are a few key metrics that I like to look in a stock screener. So I'm screening first by sector. Second, I'm looking for a market cap that's generally medium and above, but I prefer if it's even a large cap company. So they're classifying that as about $7.6 billion and above. I really prefer to look at something 10 billion, 20 billion, 50 billion, or even 100 billion and above. The next thing I screen for is total return 5-year annualized. So this is how I can see what's gone on over the past 5 years with that investment. How well has it performed? And I really want this number to be above 15%. If it's above 20%, that's great. It also depends on the economy and what's been going on over that 5-year horizon as well. And lastly, I just screen for MSCI so that I can see what has been the ESG performance. So environmental, social, and governance rating of each of these companies, because if I see a company has a poor rating, which they refer to as laggard, then I'm going to want to look into this a little further and understand what's going on behind the business. Are they doing things unethically? Are they trying to cut corners? Are they having trouble with their management team? Are they having trouble with their labor? Are they sourcing things unethically? Have they had any fraud? And you'll be able to go to MSCI and look at their ESG ratings if you want to get a deeper dive into that. If you want to learn more about that, you can check out episode 9 of the podcast, where I break down ESG a bit further and especially using MSCI to your advantage. So when I screen for the consumer staples sector in Fidelity Investment Stock Screener, I chose 5 different companies from this sector based on household names and also some interesting characteristics that you'll notice between these stocks. So the 5 companies that I'm looking at are Costco, BJ's, Walmart, Target, and Procter & Gamble. Ticker symbols COST for Costco, BJ for BJ's, WMT for Walmart, TGT for Target, and PG for Procter & Gamble. So the next thing I did, as you can see on the screen, is I took those stocks and I put them into the PYW diversification template. If you want access to this exclusive template, send me a message on social media or on LinkedIn, or send me an email, support@thevisionaryinvestor.com, and we'll send that over to you. This is looking at data over the past 5 years. And again, risk here is measured using downside standard deviation. So that's any returns over these past 5 years that were less than zero are taken into account. So on this template, we can see the market caps of these different companies. And I also am comparing it to XLP, which is the Consumer Staples Spider S&P 500 sector, essentially. It's allowing us to compare it to some of the largest consumer staple companies. So the first thing I notice here is that none of these 5 companies have a risk-adjusted return above 1. Most of them do have a risk below 20%, except for Target, as you can see here. And the reason for that most likely is because these are more defensive companies. This is more of a defensive sector. At the end of the day, a lot of these are essentials regardless of what's going on in the economy, especially if they're selling a lot of food and essential items like toilet paper, paper towels, Band-Aids, and so forth that are more necessity than some of your other sectors like consumer discretionary. Right off the bat, what I see here is that Costco and BJ's are the only 2 companies that had above 15% annualized returns over the past 5 years. I wanted to take it a step further and look at the correlations of these investments, especially compared to XLP. So what I noticed was the following. We can see Costco and XLP had a correlation of negative returns of 0.34. BJ's actually had a negative correlation of negative returns, slightly negative, of negative 0.06, Target 0.22, Walmart 0.08, and Procter & Gamble 0.47. So these 5 companies generally have a lower correlation, or medium in the case of Procter & Gamble. This is something I like to see and I teach because it's great to find those investments that aren't always acting exactly like the rest of the stocks in that sector, especially when they're also outperforming. That is an interesting way to protect your wealth. So the next thing that I did is I went over to Glassdoor, and there I looked at the ratings of the companies and the CEO ratings. What I noticed was really interesting. These are the ratings. Costco had a rating of 3.9% overall for the company, and the CEO was rated 83%. BJ's had a rating of 3.1 for the company and 45% for the CEO. It did have a lot less ratings though than these other companies on this list. Target had a company rating of 3.6 and the CEO was rated 63%. Walmart had a rating of 3.4% and the CEO was rated 59%. And the best on this list was Procter & Gamble, which had a rating of 4.1% and the CEO was rated 89%. So taking a look at this information a little further, it tells me, all right, we need to dive a little bit into what's going on with BJ's and Target and Walmart. Why are employees not happy? Unfortunately, sometimes employees may not feel like they're really a part of the team. They may not feel like they've been treated properly, and they may just feel like a number in a company, especially when you're dealing with billion-dollar companies. So looking into this further and understanding how the company is creating a good morale, how they're fostering growth, making everyone feel like a team, what is management doing? These are important considerations to look at when you're looking to invest, and do your own research too. You know, I talk about leveraging your own experience, your expertise. Let's say you go into Costco, you go into BJ's, go into a few of them, see how it's run. See how the employees seem. Are they happy? Are they enjoying what they're doing? Are they just kind of going through the motions? Understanding more behind the scenes will help you be a better investor and find better stocks for your portfolio, because it speaks volumes. At the end of the day, if people are not happy at their job and they're not being treated well by management, not only is that something that I don't feel good about morally and ethically when I'm looking at a company to invest into, realistically, long term, how is that company going to grow if it's having trouble retaining its employees? It has high turnover. people really are not happy. They're not motivated to make the sale. They're just going through the motion sometimes because they don't have the support from upper management. So there's definitely going to be additional parts to this series, but what I wanted to do is come on and do a brief analysis of what to do. So what we did here is we took a look on Fidelity Investments at the consumer staples sector. We then took a few companies that we found we were interested in, and we put them into the PYW Diversification template, which you can access by sending me a message on social, or if you want, send me an email, support@thevisionaryinvestor.com, and we'll send that over to you. Costco and BJ's are the only two companies on this list that had a risk-adjusted return close to 1. Of course, we're looking for above 1, but in my opinion, that doesn't mean it's not a good investment. What concerns me is when I look at the Glassdoor ratings and I notice, for instance, BJ's, only 45% of people who've rated the company on Glassdoor approve of the CEO. And overall, the company gets a 3.1 rating. That's definitely low. And we also looked at the correlations. We noticed that these correlations to the actual sector of these 5 companies were either medium or low, which is something that is definitely important to look at and consider. We're going to follow up with doing a more detailed fundamental analysis, looking through the numbers even further. I just wanted to do a first level analysis. Based on this, I think only Costco really would pass the test of what I was looking for, but your goals may be different, so it's important to look through what your goals are and make sure when you're investing that you're following those and seeing what is passing and what's not passing your initial stock screener so you don't waste extra time on the next step. Thanks so much for listening. Please make sure to rate, subscribe, and like the podcast. Have a great day.